Where should you put your money if a global recession hits? What if everything you think is safe suddenly isn't? What if the next global recession doesn't start on Wall Street, but begins with a banking crisis in Europe, a debt collapse in America, a property meltdown in China, or a geopolitical shock nobody sees coming? Imagine waking up one morning and discovering that your investments have lost 30%, 40%, or even 60% of their value. Your retirement fund shrinking, your savings buying less every month, your purchasing power evaporating while governments print trillions of dollars trying to stop the bleeding. And here's the uncomfortable truth. Most people will be caught completely unprepared. But not everyone. Because throughout history, every recession has created two kinds of people: those who panic and those who quietly position themselves before the storm arrives. Today, we're going to answer one of the most important financial questions of our time. Where should you put your money if a global recession becomes reality? And the answer might completely change how you think about wealth. Because some assets collapse during recessions, while others become financial lifeboats. Stay with me until the end, because the final asset on this list has protected fortunes through wars, depressions, inflation crises, and the collapse of empires. Let's begin. Cash, the king that returns during crisis. Global economy, financial survival. When markets are booming, cash looks boring. Nobody posts social media videos celebrating their cash position. Nobody brags about keeping money on the sidelines. But when recession arrives, cash suddenly becomes one of the most powerful assets in the world. Why? Because recessions create opportunities, and opportunities require liquidity. During the 2008 financial crisis, millions of investors watched their portfolios collapse. Meanwhile, those holding significant cash reserves had something extremely valuable: the ability to buy assets at discounted prices. Think about it. If stocks fall 40%, real estate falls 25%, and businesses become desperate for capital, who has the advantage? The person with available cash. Not because cash generates spectacular returns, but because cash gives you options. And in a recession, options are priceless. The first rule of financial survival is simple. You cannot take advantage of opportunities if you're struggling to survive. Cash acts as a defensive shield. It provides flexibility. It reduces stress, and it allows investors to remain patient while others are forced to sell. The goal isn't to become rich with cash. The goal is to survive long enough to buy tomorrow's winners. And history repeatedly shows that fortunes are often built during crises, not during booms. But cash alone is not enough, because recessions often bring another dangerous companion: inflation. And inflation quietly destroys the value of money. Which brings us to the next strategic pillar: gold, the asset that outlived empires. Strategic resources, history of empires. For more than 5,000 years, civilizations have trusted one asset above all others. Not governments, not central banks, not currencies. Gold. Empires have risen, empires have fallen. Kings disappeared, borders changed, currencies collapsed. Gold remained. And that fact alone should make you pay attention. Why investors run toward gold? During times of uncertainty, people seek something tangible, something scarce, something that governments cannot print endlessly. Gold offers exactly that. When confidence in financial systems weakens, gold often becomes a global refuge. It is not dependent on a company's profits. It is not tied to a government's promise. Its value comes from scarcity and trust accumulated across thousands of years. Historical perspective. During major crises, investors repeatedly migrate toward gold. Financial crises, banking collapses, currency devaluations, geopolitical conflicts, inflation shocks. The pattern appears again and again, because when uncertainty rises, trust becomes the most valuable currency, and gold has accumulated centuries of trust. Gold is fascinating because it is both ancient and modern. The same metal valued by Roman emperors is still accumulated today by central banks and sovereign wealth funds. That tells us something important. The world's most powerful institutions continue to see value in it. And when institutions are buying protection, ordinary investors should at least understand why. But here's the question nobody is asking. What happens if the next recession isn't just a recession? What if it's accompanied by exploding government debt, currency instability, massive money printing, and a complete loss of confidence in traditional financial systems? In that scenario, cash may not be enough. Gold may not be enough, and investors may start looking for entirely different forms of protection. Where should you put your money if a global recession hits? Before we continue, remember what we've already discovered. During a recession, cash gives you flexibility. Gold gives you protection. But here's the problem. A severe global recession can last years. And if your money simply sits still, you may survive the storm, but you might miss the greatest wealth-building opportunities that emerge from it. Because every economic collapse creates losers and future winners. The real question is, how do the wealthy prepare before everyone else realizes what's happening? Let's continue. Government bonds. The crisis hedge of institutions. Global economy, financial stability. When panic spreads through financial markets, something interesting happens. The largest investors on Earth often move toward government bonds, not because they're exciting, not because they're revolutionary, but because they represent safety, at least relative safety. When investors fear stock market crashes, bankruptcies, and economic contraction, many seek assets backed by powerful governments. This demand can drive bond prices higher during recessions. Expert perspective. Recessions often trigger a flight to security. Institutions managing billions of dollars are less concerned about spectacular gains. They're focused on preserving capital. And preservation becomes the priority when uncertainty dominates the global economy. The irony is fascinating. During periods of optimism, investors chase growth. During periods of fear, they chase protection. Human psychology rarely changes. Only the destination changes. But bonds are not the only place where intelligent investors look during downturns. Because some companies possess something extremely powerful, something recession-resistant, something many people underestimate. High-quality dividend stocks, getting paid to wait. Global economy, long-term wealth. Not all companies suffer equally during recessions. Some businesses provide products people need regardless of economic conditions. Electricity, food, healthcare, basic consumer goods. People continue buying them even during difficult times. These companies often generate stable cash flows, and many distribute a portion of their profits to shareholders through dividends. Why this matters? Imagine two investors. The first owns speculative assets that generate no income. The second owns high-quality businesses that continue paying dividends. Who sleeps better during a recession? The answer is obvious. Income creates resilience. Income creates patience. Income reduces the pressure to sell during moments of fear. Historical observation. Many of history's greatest investors accumulated shares of strong businesses during periods of panic. Not because markets were optimistic, but because markets were pessimistic. And pessimism often creates opportunity. The stock market is one of the few places where people run away from discounts. When televisions announce crisis, many investors panic. Yet the wealthy often begin shopping. That psychological difference changes everything. But now we arrive at the most controversial asset of all, an asset that some call digital gold, an asset others call speculation, an asset that divides economists, governments, and investors worldwide. Bitcoin. And what happens to it during a global recession may surprise you. Bitcoin, safe haven or high-risk bet. Technology, global economy. Bitcoin was born after the 2008 financial crisis, a period when trust in traditional financial institutions collapsed. Its creators envisioned an alternative system, a decentralized form of money beyond government control. Since then, Bitcoin has become one of the most discussed financial assets on Earth. Supporters argue that Bitcoin offers protection against excessive money printing. They believe scarcity gives it long-term value. Unlike traditional currencies, its supply is limited. Only 21 million Bitcoins can ever exist. For many investors, that scarcity is attractive. The skeptical view. Critics point out something important. During moments of extreme market panic, Bitcoin has often behaved more like a risk asset than a safe haven. Its price can be extraordinarily volatile, and volatility can be dangerous when fear dominates markets. Bitcoin may become part of the future financial system, or it may remain highly speculative for decades. What is certain is this: investors should understand the risks before treating it as protection, because survival always comes before speculation. The biggest mistake people make during recessions: behavioral finance. After studying countless financial crises, one mistake appears again and again. Panic. Not inflation, not recession, not interest rates. Panic. People sell assets after they crash. They buy after prices recover. They react emotionally, and emotions are expensive. Markets eventually recover. Economies eventually recover. Innovation eventually returns. The investors who remain disciplined are usually the ones who benefit most from the recovery. The greatest enemy of wealth is often not the market. It's fear. Because fear convinces intelligent people to make irrational decisions. And every recession writes the same story. Only the names change. Max Kinsey, GEO-X. So where should you put your money if a global recession hits? The answer is not a single asset. The answer is preparation. Cash for flexibility. Gold for protection. Government bonds for stability. Strong dividend-paying companies for income. and carefully measured exposure to emerging assets for long-term opportunity. Because nobody can predict the future perfectly, but history teaches us one powerful lesson. Those who prepare before the storm arrives suffer less when it does, and often emerge stronger afterward. The next recession may destroy billions of dollars in wealth. It may shake governments. It may reshape industries. It may redefine the global balance of economic power. But for those who understand the game, a recession is not just a threat. It is also a transfer of opportunity. The real question is not whether another recession will come. History guarantees that it will. The real question is, when fear takes over the world, will you be among those who panic, or among those who are already prepared? Because the fortunes of tomorrow are often built during the crises of today. Will Max Kenzie, GEO-X. Where the future of the world is decided